Hi, it's Oliver from Freeman Publications here, and in this video I'm going to be showing you something we have created that will help you become a better and more consistent investor. So, as you can see on the screen right now, I have a Google Sheet up, and what this is a logbook. And the reason we created this is because probably the most common question that we've received over the past 9 months, both in emails and within our Facebook group, is from people who they get a lot of ideas and they hear about a lot of companies and they're researching a lot of stocks, but they're not too sure which ones to buy based on what they hear about. And that's a pretty common problem, and it's one that I think affects basically everyone. Because we live in a world where information is abundant. I can go on Facebook right now, or I can go on the Wall Street Journal or Market Watch, and immediately I will be bombarded by news about 20 or 30 different companies. And it's very overwhelming, and you don't always know where to go from there. And that's why we created this logbook. Because there's a great quote from Peter Drucker, which is, "What gets measured gets managed." And so the reason we created this is because every time you get an idea, or every time you think about a stock you want to research, you simply write it down. And once you write it down, you cross-check it against these 10 criteria that we have on the screen here. And these are our 10 criteria for a good long-term investment. And I'll just quickly go through these one by one. So first one is, do you understand the business? You should never invest in anything you don't understand. That's pretty self-explanatory, but I think if you've been doing this long enough, you've probably invested in something you didn't understand, whether that's based on where you heard about it or whether you were just in a hurry because you thought it was such a great opportunity. This is item number one, and it's probably the most important item. The second one we have is it in a growing or stable industry? It's very rare that we want to invest in a company that is on the decline or is in an industry that is on the decline. Most of the time we want an industry that's either growing or stable. Does your company have an intangible asset advantage? So intangible assets are things like intellectual property or brand loyalty or fantastic management. We'll talk a little bit more about management going forward. But for example, a company like Berkshire Hathaway has a massive intangible asset advantage because of Warren Buffett at the helm and his reputation. You can't really quantify how much Warren Buffett is worth to Berkshire Hathaway. Same with a guy like Charlie Munger or a guy like Elon Musk at Tesla. That is a huge intangible asset advantage. Another criteria we want is, does the company have a moat? Does the company have a certain process that makes it very difficult for other companies to disrupt it? A company like Google, for example, has a huge moat in the fact that very few people use another search engine. It has that network effect, and therefore it's very difficult to disrupt the search engine industry. Same with Facebook. Huge moat just by the fact it's got a huge number of customers. And now they own Instagram as well, and that has a huge customer base all unto itself. Other examples of economic moat are things like brand names as well. Coca-Cola, Disney, all of these characters, all of this brand loyalty, that's a huge moat. Companies like Altria or another tobacco company has a moat because of regulations and what you can and can't do within that industry. There are very few people in Silicon Valley right now staying up all night crunching the numbers about how to disrupt the tobacco industry. It's just not happening. So that's another example of a moat. Does the company have strong management? Has there been a lot of turnover lately? Has there been a lot of people coming in and out of the board? Has there been a scandal in management? That's all things to consider. This is really cool. Are company insiders buying the stock? Now, Peter Lynch talks about this a lot in his book One Up on Wall Street. And it's a really great metric to use when you're looking at a company. Because if people on the board or the CEO are buying the stock, that's a very good sign. Because in theory, people on the board of the company should know more about the stock than anyone else and know more about the company's prospects. So if they're buying, that's a very good sign. And let me just show you where to find this right now. So we'll go to Yahoo Finance. We'll go to Berkshire Hathaway. Actually, no, we won't. We'll go to Peloton, because that's an example that's in the news a lot lately. And so you can find all this information on Yahoo Finance now. And what you do is you go to the Holders tab, and then you go to this one, Insider Transactions. And what this will show is it will show you the insider transactions for the last 6 months. And this is really, really useful. So there have been 31 million shares bought and only 1.6 million sold. So the net for that is almost 30 million shares have been bought by insiders at Peloton. And that is a really, really good sign, because it means that management is very bullish on the stock's growth. And if management's bullish, that's a very good sign. Another thing we like to look at is, does the company have a recurring revenue source within the business? So all of these software companies where they bill customers monthly or yearly, that's recurring revenue rather than a one-time transaction. A company like Apple has recurring revenue not only through software, but because people buy new iPhones and new iPads and new MacBooks every few years. So it's not just a one-time purchase. We like to see recurring revenue in a business. It's no longer just something that's nice to have. It's kind of essential now. And that's why companies like Netflix have been able to be so successful, because they've moved from an ownership model to a model where you're renting the service forever. Growing earnings, this is another one we like to see. Does the business have growing earnings? You can find this on the financial statement very easily. You can find it on Yahoo Finance. You can find it for free within about 2 minutes. Does the company have growing earnings? And you should know that if you're going to put your money into a company. Same again, healthy cash position. How is the cash position in relation to the debt? Does the company have enough money to survive if there's bad economic conditions, which is what this criteria is all about? Can it weather a storm? Or is the company just hoarding cash without any real idea of what to do with it? Company like Berkshire Hathaway has a great cash position, and they have a track record of using the cash well for acquisitions or taking stakes in businesses. And then the final one is, can the company weather a storm? Does the business have the ability to survive if economic conditions aren't perfect? Businesses like airlines, hotels, really, they need optimum economic conditions to do well. And as we've seen earlier this year, if that's not happening, they have huge capital expenses and huge fixed costs, which they can't make up if there's a less than ideal economic situation. So these are our 10 criteria. We like to buy companies that have 8 or more of these, and on the Google sheet here, I've made it so you can just tick which criteria those companies have. Then we have some basic financial ratios, PE ratio or price to sales ratio if the company's not yet profitable. Projected growth rate in the next 5 years. You can find that on Yahoo Finance, and there is an accompanying PDF to this as well, which I will show you where to get for free, and that details where you can get all of these numbers. Then I've included this, and you might be thinking, why have you included a section for the price of a company 30 days after you first heard about it? And the reason I've done that is to overcome a human bias called price anchoring. Now, price anchoring is where the day you first hear about a company, one of the first things you do is look up the stock price. So let's say I first heard about Berkshire Hathaway 2 weeks ago on the 27th of November. And the current price then was $231 a share. In a month, the price might be different. It probably will be different. It might be higher, it might be lower. But a lot of the time, and I see this a lot with novice investors, they worry that every time they see a company, they first hear about it, and they don't invest, and then the price goes up. And then they see it again in 3 months, and the price is up even more. But the companies they have bought, sometimes they buy it, and in 3 months the price is down. Now, the reason this happens is because our brains are horrible, and they trick us. Because we remember times when we have lost out more than times when we've benefited. And I could spend hours talking about this single concept, but the short reason is our survival instincts kick in, and we have a greater fear of losing out on something than we do of gaining something. So you generally remember times when the price is up 90 days later as opposed to times when the price is down. But if you write everything down and you go back and look through your own notes, you can see whether that's true or not. You can see whether that really is the case. And that's why the idea of writing everything down is really, really useful, because it will confirm your suspicions or not. Because chances are, when you first hear about a company, 50% of the time the price is going to be higher in 90 days and 50% of the time it's going to be lower. But you just need to confirm that for yourself. Is that really the case? And I actually like to do this all the way to 1 year later, because you need to see, were your initial assumptions correct? And then if you did invest, was it a good idea? If you didn't invest, why didn't you invest? Because if you see a pattern where you find these great companies, but you never invest in them, and then 6 months later the price is always higher, then there is a problem there. But if you also see a pattern of you're finding companies, you don't really do research, you buy them straight away, they don't meet these criteria, then 3-6 months later the price is lower, once again, you found the solution to your problem now. And the problem is you just didn't do enough research. So the whole idea of this is just to help you overcome your own biases and help you avoid getting anchored to the price where you first heard about the company. Now, this is actually in 2 parts. So we have the spreadsheet here, which you can get a copy of, and I will link down below where to get your copy. It's 100% free for the digital version. If you want to get a physical version of this inside a book, then go to the link above, freemanpublications.com/logbook, and that will take you to Amazon where you can get a physical copy. And here's what the physical copy will look like. So you will get this. It's 120 pages, and the first 20 pages are just explaining why we've chosen each criteria. So we show you exactly how to use the book, like I've just explained in this video. We show you why each of the criteria are included and why we've included them. Then we also show you where to find all the numbers. So we show you, you can do the whole thing on Yahoo Finance. It's very, very convenient. We show you exactly where to look for all the numbers. where to find, price to sales ratio, for example, where to find the growth rate, where to find the insider buying and selling. And then you also get 100 pages of this sheet, so you can write down all your ideas, and then there's a notes section below as well. So we filled out one just as an example here for Berkshire Hathaway, and then you get 100 pages and 2 ideas per page to fill in everything for yourself. And what that will do is just help you note down not only your ideas, but your biases and where you've made mistakes in the past. And so what I'd recommend doing is getting a digital copy of this, or if you want a physical copy, get a physical copy as well. And then for the next 30 days, every single time you hear about a company and you are interested in buying the stock, I would fill out all of this before you do anything. Before you buy the stock or before you move on, fill out all of this information for yourself, then make a decision. And that will really help you not only find companies that are great prospects, but it will help you avoid companies that are absolute duds, but people are just hyping up for whatever reason. So if you want the digital version, what I will do is I'll link it down below, and I will also link the digital version of the PDF so you can have all of the information as well and where to find everything. And then if you want the physical version, go to this link, freemanpublications.com/logbook, and then that will take you to Amazon where you can get a physical copy of the book. So I hope this is useful, and if you've got any comments or any other things you'd like us to include in here that you think would be useful, just let me know in the comments down below. Send me an email, admin@freemanpublications.com. So I hope you enjoyed this video. Have a very happy and healthy holiday season, and good luck and stay profitable.